Welcome all of you, and thanks for joining us today's webinar. And I know it's a long weekend for 4 days, and it's difficult for taking time out of your busy schedule, but it is even more difficult to take out of time out of your holiday or leisure day. So, without taking any further of your time, I shall kickstart today's webinar, which is understanding the debt markets with my colleague and friend Satyakam Gautam, and he is an expert in this field. So the way we have divided this webinar is into three sections. First, we will give you a brief overview of who we are, what is Giraffe, and what we do. Second, then in the second section, we'll have interaction with Satyakam Gautam, where I will be asking some questions from him and try to understand from him and learn from his experience. In the third section, we will have audience questions, and you can type that in Q&A section, and I'll take them and ask these questions from Satyakam Gautam. Please note that we will not be taking any deal-specific questions, and that's the boundary. And there could be some products whose answer we might not be able to address in this webinar, so that we will take in subsequent sessions. So I'll just start with a brief introduction about Giraffe and who am I. So just to introduce myself first, my name is Vikas Bansal, and I have been a corporate banker for last 15 years. Before joining Jiraaf, I was with the Kotak Mahindra Bank and heading their northern region for banking and financial institutions group. And in Jiraaf, I look after the origination, which is like the deals which you see on the platform are originated by me. And I am a graduate from IIT Kharagpur and I am Lucknow. So that's a brief about myself. And I'll just share my screen and give you an introduction about Giraffe. I hope you are able to see my screen. Satyakam, can you see it?
Yes, perfectly.
Yeah. So first of all, what is Giraffe? So Giraffe is a platform. What do I mean by platform? It's a website where an investor can come and invest in high yield alternate investment opportunities. So what do we, so there are a lot of technical terms being thrown here, high yield and alternate investment opportunity. High yield, what we define is something which is more than 10% and up to 22%. So that's our definition of high yield. Alternate investment opportunities. So alternate investment is something which is not market linked, like equity markets. So everyone of knows how to invest in the stocks. So it's a fairly mature market. So something which is not market linked and something which is not FD, fixed deposit. So anything in between is called alternate investment opportunity. So there are many financial products. It could be as exotic as investing in the art, wines, vintage cars. But through Giraffe, we are only bringing financial products at our platform. So this is how we define alternate investment opportunities. So what is Giraffe and who are the guys who started it? So Giraffe has been founded by Saurabh and Vinit. So just to give you a background about the founders, Saurabh is an IMA grad. He is a pass out from 2012 and has almost a decade experience in corporate finance. And he is a engineer by trade, and he did it graduation from BITS Pilani, Goa. Vinit is a graduate from XIM Bhubaneswar. He was one of the founding team members from Piramal Enterprise, and he has done almost a volumes of AUM 7 billion. So that's about him. So I have a colleague, Pratik Goel, who heads the strategy, and he's also Ahmedabad graduate. He has been associated with VC funds, and his last stint was with a VC fund, and he has most of the opportunities that you see from VC and leasing space are originated by him. And I've already given a brief about myself, so I'll skip this part. So we have two advisors on our platform, which is Mr. Srini Gopalan and Naveen Datta. Srini has a total experience of more than 25 years of experience. He has played multiple roles in CEO and CFO with a different organization. And similarly, Naveen has been into real estate financing. So we derive comfort from their experience and we try to learn from them. And whatever opportunities and deals we put on our platform, we run past through them and learn from their expertise. And Giraffe is backed by marquee investors. So we have Siddharth Shah from Easy, Ramakant Sharma, list based, Prashant Singh from MedLife, and Dharmal Seth. And while we are talking to you, we are in the process of raising fund from a marquee global VC fund. So that should be in public news very soon. So we hope in this month you will hear that we have been able to onboard a very big, large, one of the top 5 global VC fund. So moving on. So what exactly is alternate investment? How do we define it? So if you see on the right hand side, you will see historically the people have been investing in physical assets, which is gold, real estate, other jewels and jewelry. And off lately, in last say 15, 20 years, people have moved to financial products, which is equity and mutual fund. But that also forms a 23%. And a very low percentage, which is like alternate investment, is forms only 1% of the portfolio. So people do savings mostly because of the tax saving schemes or FDs or gold or real estate. So we are trying to balance, we are trying to bring some opportunities where you can invest in non-market linked opportunities. So on one hand, you have equity, on another hand, you have debt. So in equity, the returns are totally market linked. And if FD, if you invest today, you get a maximum of in 1 to 2 years, 5% return. So there's a whole gamut of products. If you see this graph, yield and return. So you can see there's a whole gamut of returns from on the one end is FD and savings, and on the other end is equity market. So there are a whole host of products which are present. However, the individuals have not been able to participate in these products. And it is due to various reasons. First of all, there is a lack of knowledge. Second, there is a lack of reach. Third, there is a minimum ticket size required to invest. So these products are not something new. This is not something that Jiraaf is inventing. These products have been into market for a long time. However, these products were not accessible because the minimum ticket size, if you go through AIF route, is 1 crore, and if you go through PMS route, is 50 lakhs. So what is our endeavor? We want to educate the investors. So what are these products? We want you to learn, understand the risk, and then take a call whether you want to invest in it or not. Secondly, the reach has become much wider because of the internet, advent of the internet, and it's easier to reach out to the masses. So just to give you an example, we have been able to connect through webinar, and maybe this due to COVID, it has tended all of us went to webinar. However, it was very difficult to reach a large base, say 3-4 years back, and to explain to the public what are the risks involved in this. Third thing, what Jiraaf is doing, Jiraaf is trying to bring down the ticket size. Fourth, which is the most important thing, what we are doing, we are just not just marketplace. We don't allow anyone and everyone to list on our platform. Jiraaf, we curate each and every deal. We do our thorough checks and understand each and every opportunity. Then we list it on our platform. So the three things that you should take away from this slide is alternate investment is an upcoming space which forms only 1% of the portfolio as of now. And this is the space that we currently are dealing with. For a short tenor, we have noise discounting, structured credit, venture debt. We are not into the other exotic end of the alternate investment like crypto or art or wine investing. We are not there. Moving on. So why there is a need of Jiraaf, which I've already covered. So the market today is such that if you invest in the fixed income products, which we usually understand is FD, you get a return of 5 to 6%. And a structured product is something which is not readily available, which I told you, if you want to invest it, you have to either go to PMS or AIF. And third thing, there's no robust mechanism available for you to, even if you invest it. These are the blind pools, and you don't know how to monitor it. Fourth thing, the documentation is very cumbersome. The payout is not transparent. So this is where Jiraaf comes into being. We are trying to address all these issues and help them. So what is it for investors and partners? So as you know, there are many good corporates or SMEs who are unable to raise funds from the traditional bank because they ask for security and they are loss making or they are high growth companies, and the banks have their own parameters and own structures, so they are unable to lend to them. So what Giraffe is doing, we identify those opportunities. So it does not mean that these are high risk opportunities. We curate each and every opportunity. We understand the business, underlying business. We understand the cash flows, and then we bring it to our platform. So what I'm trying to say is each and every opportunity is thoroughly evaluated, understood, and then brought to you. And the risk is understood by us, and that's what we try to explain it to our investors. And for the investors such like you, so that the advantage is the same. You get a high yield, and it's a multi-tenor platform. You can invest from 1 month to 3 years. There are different products as per your risk appetite, as per your requirement of cash flows, and as per your need. So there is a one unified platform which offers you a fixed income returns, and you don't have to go to other platforms. So this is one. So it's like a Walmart or a you can say Amazon of debt. And we have a credible team. I've already told that all of us are a fairly seasoned guide. All of us have a decade or more of experience, and we have worked in this sector, and we understand this sector well. And we are trying to solve a problem out here, which we think is addressable. Moving on. So just a small graph, what we do. So it's more from the investor's perspective. So if you want to invest into any of the opportunities, you need to log into our website. So there could be at any time of point 1 to 3 deals or maybe more deals available on our platform. You can choose it, you can understand it. We upload all the documents. We try to explain the risks onto our platform. And even if you have further queries, you can reach out to us through support desk or on our through a call. And you understand the risk and you can invest through it. The entire process is very seamless and all the documentation is online. There is no paperwork, and you can, after you invest, you can monitor your entire investment through our platform. And from the borrower's perspective, what do we bring? So they have easy access to capital. We can turn around really fast. So there is a gap in the market which we are trying to understand, the capital seekers and capital providers. We are trying to bring them closer. So there is at times, if you see a traditional bank would keep a margin of say 4 to 5%. So what we are trying to do, we are trying to bring both of them together. So there is a more capital efficient allocation for both the parties. So what are the products that we have on our website? It is NCDs and MLDs for NBFCs, which is a tenor from 1 to 3 years, and opportunity could be anything more than 10 crores. The minimum ticket size is 1 lakh, and the yield could be 8 to 14%. Then we have a short tenor products, invoice discounting, which is by nature 1 to 6 months, and again the ticket size is 1 lakh, and the yield is 1 to 5, 88 to 15%. I'm sorry. And then we have corporate debt, leasing, and venture debt. So these are the 5 classes we are currently offering onto our platform. And the minimum ticket size is 1 lakh. And the tenor, as you can see, is lasting from 1 to 36 months. And each of them can have varying cash flows. And it depends on the investor and it needs in which opportunity they want to invest into. Our track record, so we started 9 months ago. And our website was launched on Ganesh Chaturthi, that was 10th of September. Since then, we have done a total volume of 250 crores, and investors have already participated around 243 to 44 crores, and we have returned a capital of around 40 crores. We have grown from a small team of say 5 to 35 in a small span of time. We already have, so today the registered investors are more than 9,800. The investors who have put in money in our deals is 400. We have partners which are channel partners, which are 51. So our endeavor is to create a world-class platform for the alternate opportunities. And this is for India, and this is like a Make in India and for India platform that we are building up. So that's all from my side. So I'll just stop sharing my screen. So I have along with me Satyakam Gautam, and I'll just give a brief introduction of his. Satyakam Gautam is a DC 2003 mechanical engineer graduate, and he did his graduation in IIM Lucknow. He has total 15 years of experience. He has traded in global debt markets as well as Indian fixed income markets. He has a vast experience which spans across government securities, corporate bonds, money market instruments, and as well as in interest rate future market of Europe and US. So we are here to welcome you, Satyakam. Thanks for joining us. And we would like to understand from your experience. And today we want to learn from you. So that's the idea.
Thanks, Vikas, for the great introduction. So, where should we start with?
So, anything you want to add to your introduction? Maybe I have missed something. Anything you want to tell us about yourself?
So, broadly, I like reading about macros, both local and global. I want to visualize future, like how it is likely to happen, rather than delving too much into past and present. And I think talking to market participants, reading as much as possible, keeps you aware about market updates. So that's my passion and that's my interest. So I'm very frequent writer on LinkedIn, etc., on macroeconomics related to debt markets. So that's how I want to build my interest and passion. So let's see how it goes.
Good. Thanks, Satyam. So, so I'll go the standard question, which is the topic of the day. We want to understand the debt market. So, what is the debt market? How do you define it, and what's its landscape in India?
So broadly, if you look outside India, debt markets are far bigger and larger than equity markets. So if you look at if you look at the US Treasury markets, they are almost 6 to 7 times the total market cap of S&P. Okay, but unfortunately in India, the debt markets are not that widely read about or not mostly discussed about in public media. So it's a very small set of participants who function in debt markets. Broadly, like if you look at debt market participants, it would be mutual funds, nationalized banks, private banks, insurance companies, and RBI itself, and PDs, primary dealers. In terms of products, it's mostly G-Secs. We start from the T-bill, which is the shortest end of the curve, which is 3 months, 6 months, 12 month. Then we have got money market instruments like certificate of deposit, CDs, which are basically issued by banks. Or we have got commercial papers, which are basically money market instruments issued up to 1 year by corporates or NBFCs. And then as you move ahead the yield curve, when I say the yield curve, it means as you move ahead in terms of maturities, we have got corporate bonds issued by corporates. We have got G-Secs 5-year, 10-year, 15-year, 30-year, and subsequently. So the basic yield curve is the sovereign yield curve, and that sovereign yield curve keeps on, let's say, getting added by the credit spread for various kinds of ratings. So let's say the 10-year G-Sec is right now trading at 7.20 or 7.30 annualized. So the 10-year corporate bond is somewhere around 7.35. So the entire yield curve is made up of mostly institutional players. The retail participation in debt markets in India is unfortunately not too much right now. RBI has been trying to stimulate the retail demand. Now they have started giving the access to NDS home also to retail via CSGL accounts of banks. So let's see how it goes. Hoping that in the next 5 to 10 years, retail participation in GSEC is as good as what has happened in equities in the last 3 or 4 years, if you have noticed. So let's see how it goes.
So what I understood, Satyakam, is like equity markets are a smaller segment than the bond market in the developed world, and the major you'll have to explain like the major products that you say the debt includes is the government securities, which could be treasury bills, which are I think less than 6 months, and there are government bonds which are issued by government of India. Then there are debt papers, which is like corporate deposits, which are issued by the banks. And the third thing is corporate bonds. So these are some of the products which constitute the debt market.
Correct.
And the major players who are investing in these opportunities are the institutional banks, the institutional clients, the large corporates to the like of say Aditya Birla, Reliance, or India Bulls, or say any other institution who invest into this for active treasury management. and they are primary dealers who involved in the buying and selling of the government securities.
Correct.
So these are the major partners. So one thing I see is that retail participation is low in this market.
Right.
That's the one takeout I took. And something you mentioned, I'll cover one by one. So somewhere you mentioned about the yield curve and about the credit spread. So give me a moment. I'll come to that later. So why?
So
which
just
one
to,
is more risky?
just to
Equity or debt? So let me get into very. Why is the debt market so small? Is it because the risk, which is more risky, equity market or a debt market?
look, purely from a risk reward perspective, an equity investment uh, in a normal scenario is made for a kind of investor who is, let's say, 30-35 years of age, who is willing to stay invested for a longer period of time, and he has the ability to take some amount of risk. So that kind of investor profile is made for equity investments. When you look at debt itself, it is more for steady returns, accruals, and capital conservation is a key here. Okay, so from a portfolio allocation point of view, even for anybody who is at the age of investing of, let's say, starting from 30-35 also, the entire portfolio can't be allocated to any single asset class, whether it be it equity or bonds or gold or real estate. So it has to be a mix of equity, some equity. Let's say if you are at the age of 35, you would put 50 to 60% of the overall portfolio in equities. You would put 10% for gold as preservation. You need to have 20 to 30% in debt, definitely, to give you that some amount of capital conservation as well as regular accruals. But as you move ahead in life, let's say when you, let's say, enter the age of 55 or 60, perhaps you need to have a portfolio which is little conservative than what you had at the age of 35. So then you need to have more debt in your portfolio, which gives you regular accruals. There your capital conservation has to be ensured. So there the equity proportion goes down. So there are two things. The first part is the individual investor profile, which is very critical in determining the allocation towards various asset classes. The second thing, which I really feel that more people should talk about, is the relative pricing of various assets. Okay, so let's look at equities versus debt in India right now. So, if I just look at purely from 10-year US bonds are trading at, let's say, 2.80 right now. Okay, the earnings yield of Sensex is right now 3.90. So this difference between the 10-year US and the Sensex earnings yield is around 110 bips. Now, this is very, very low spread. Why? Because if you remember in March 2020, pre-COVID times, that spread was around 480 bips. So now the attractiveness of equity as an asset class compared to 10-year US treasuries has actually significantly reduced. Okay, so that's what the point I'm trying to make. Second point is, if you look at 10-year Indian government GSEC yield, it's trading right now at 7.2. The earnings yield of Sensex is 3.9. So that's a spread of 330 bips odd. Okay. If you look at the average spread has been on 265 on an annual basis for the last 15 years. Again, it implies that either the GSEC is undervalued or the equity is overvalued. Okay.
Correct.
So whatever parameter you want to use, okay. The second parameter which I want to use is 2-year UST. So if the 2-year UST is trading at 2.45, hedging cost for any FPI for 1 year forward is 4%. So 6.4% he has lost from day one. Okay, as a relative comparison. So I mean, do you really see a 1 year forward PE of 21 Sensex performing that well in near future and is likely to give 6.5% plus kind of returns? No. That's why you are seeing the maximum outflow of FPI from equities. So around $20 billion of money has flown out of, let's say, Indian equities in the last 4 months. Now, it's not that I am saying that equities are always bad. Okay. The point here I'm trying to make is, first is individual risk profile. Second is relative pricing of the various asset classes. Okay, so right now, according to me, if you ask me purely from a pricing point of view, local fixed income, local debt looks very attractive to me compared to equities. And especially if you look at, let's say, the double A curve, which you guys operate in, which is the high yield corporate bond curve. There specifically, I feel that post the Templeton fiasco, which happened in March 2020, then after that, there's been a freeze in credit markets. So there is obviously, as you rightly pointed out, that there's a lack of connection between the need for capital and those guys who can provide the capital. So I think there are excellent, attractive opportunities in high yield market right now. So somebody who has either got the time and the efforts to go after and understand the product well, or he has got a, let's say, very able set of advisors who can advise them. I think there are significant attractive opportunities out there in the double A yield curve as well. So, mota moti, what I'm trying to make here is that nothing is constant in terms of asset allocation. First, second, you always have to be flexible in terms of your individual investments across various asset classes.
So that's quite a lot to digest in one one book. So I'll just try to rephrase what you have already said, and if my understanding is correct. So debt is something. The allocation between debt and equity depends on one's lifestyle and according to the need. So if somebody is younger, he could look at a higher portion of allocation to equity because he has a longer time spent for equities to play out. So if somebody is 35, he can stay invested for say maybe next 30, 40 years, and then he can get a return because as we all know, equity market is slightly choppier. Second thing is like you said, debt somebody should invest into for capital conservation and steady returns. So this is the second theme which I understood. So there should be not extreme on both ends. It depends on the risk profile of an individual where he wants to invest into. Then what I understood is that currently the spread between the equity market and the bond market is very low. So it could be either because of equity markets is overvalued, or it could be due to the debt markets are overvalued,
Undervalued.
undervalued.
Yeah.
So it could be because of either reason. So I don't know which one because of it. Third thing is I would like to understand how does one evaluate these opportunities since we are talking to the individuals, and uh, how does how does our player, our investor knows is it a good opportunity? There's not much research going into it. Say what are these triple A, double A, triple B, and how should they be priced? Because there's no active trading going on. So whether the level which they are trading is actually the right price for them. How does one arrive at it?
Right. So first thing is that each individual investor needs to figure out what's his requirement, okay, in terms of the IRR, what kind of returns he's looking from debt in his overall portfolio. So my sense is that if somebody is looking for beating FDs, okay, just beating FDs and keeping a very low risk profile, no credit risk, etc. Even then, you'll just look at the yield curve right now. 5-year SBI FD is right now 5.45. But if you look at 5-year NABARD, it is trading at 6.85, 5-year HDFC at 7.05. So there's a delta of around 100 to 50 bips over and above the FD rates. So if you just want to beat the FDs, don't want to take any great risk, you need to perhaps shift towards these corporate bonds because these gives you higher amount of carry. Okay. Second thing which somebody needs to keep in mind is the cash flow requirement. If somebody has a definite idea that the cash flow is not required for the next 5 years or 6 years, then target linked index funds, especially for SDL or G6, makes sense. With which there are many products in the market right now. Third thing is if somebody has an interest towards getting some additional return based upon what we are discussing, there is a significant mismatch between the requirement of capital and those guys who are willing to provide it. Then maybe he or she needs to research those credits, look at the credit ratings, go through the credit rating rationale of these individual credit rating agencies, look at the financial performance of that particular company, of that particular credit for the last 5 years minimum. Okay. And then before dipping into something, he or she should keep an eye on what are the levels being traded in that particular paper, let's say a double A paper or a double A plus paper, for a certain period of time before straight away going and buying or selling. So clicking the button is very easy. You need to at least give 3 to 6 months to understand the product. Okay. And as your organizational stance, it's your responsibility as well to educate the investors that how this is an opportunity, right? Because first of all, you have to make the investor comfortable with the concept. Okay. He will become comfortable only when you try to pass on the information that this is the reality and there is a mismatch here. Okay. So this is an opportunity for you. So first time, second time, third time, fourth time, you keep on reinforcing that opinion, and finally he would come across to that. And then after seeing for some point of time, then he would start allocating some resources to these credit papers, which I think there is a significant opportunity in the next 2 years.
So one of the questions I get oftenly asked, Satyakam, is that say for the risk we have equity. If we want to take risk, we'll do it in equity and keep it investing. For capital preservation, we have everything. Why go into bond at all? Because these are some of the bonds are giving as high return as 12 and 13%, maybe 10 plus. So should we actually look at them? Are they as risky as equities? I know it relates to the previous answer. So how should an individual look at these products?
Maybe there is not a, I don't think it's a competition between a high yield debt product versus an expected strong equity market. There is no competition between them. Both can be equally possible. So in the last 2 years, Nifty has rallied from 8,000 to whatever 16,000, 17,000. For the last 2 years, high yield trade papers are still trading at 12%, 14%. They have matured almost like for n number of companies, they have matured for almost 2 years and still trading at 14%, 12%. I don't want to name the companies. So there's an opportunity there as well. So you would have made money by remaining invested in Nifty at 8,000 to 16,000, and you would have made money here also. So my sense is that you need to keep an eye that maybe I need to not put all my eggs in one basket. Maybe I need to diversify. Okay, maybe I need to have some allocation to equity, some allocation to let's say high yield trade papers, some allocation to let's say AAA corporates, and then some allocation to gold because gold is anyways required in the portfolio allocation.
So
So
I'll ask you questions in one go. So sorry. So when you say debt papers, we have seen in the past ILFS and Yes Bank and many other corporations, the bonds go belly up. How does an retail individual investor? I take compound in the debt market without. So my entire capital is eroded. At least in equity market, they are easily tradable. I get a time to exit the market, and my capital loss could be lesser. Second thing, like as an individual, I don't know what are the factors which affect the bond market. So would you be able to help us out on these two points?
okay, so I mean, picking up from your last part, the factors affecting bond markets, there are one part is the macro part, the other part is the micro part. Okay, so the first of all, I will cover the macro part. So the macro is basically means what is happening in the domestic macroeconomy, whether it is inflation, whether it is IIP, whether it is GDP, whether it is auto retail sales, whether it is PMI numbers. So you have to start tracking economic numbers. Unfortunately, in India, we don't have much amount of economic data. I mean, beyond these 4 or 5 economic data points and the quarterly GDP which comes out, you don't have much data points. But at least you can make an effort to go through and figure out what kind of data points are coming over a period of time. So anybody who has been reading CPI, he or she would have noticed that for the past 3-4 months, CPI readings have been plus 6%, and it's a major topic of concern for the central bank as well as for the government as well as for the common people. Okay, so so if somebody has read about that, he would be aware that we are going to be soon in an era of higher rates. It has happened in US already and likely to happen in the next 6 months, 1 year. It is likely to happen in India as well. So how do I protect and how is my investor going to behave in a rising interest rate scenario, right? So the first thing which would come to his mind is in a rising interest rate scenario, an equity market, especially at such an elevated levels, would not perform as well as even a AAA bond. I mean, especially if it is what you call is target linked investment in bonds. Okay. Plus the fact that there are so many things happening globally. I mean, at least we can read about what's happening by various global central banks like US Fed, Bank of England, etc. You can keep an eye on commodities prices. Anybody who has been reading newspapers would know that for the past 4 months, oil has moved from 80 to 120, right now at 110. Okay, commodities like nickel, copper, aluminum, everything has gone up the roof. Everything, the prices of these commodities are up by 30 to 40%. And there is a fundamental reason behind that. It's not just Ukraine, it's not just printing by Fed. There is a fundamental reason. According to me, if you look at data, so between 1990 to 2010, in those 20 years, if you have invested $100 and got, let's say, X amount of nickel, okay, in the next 10 years, from 2010 to 2020, if you invested again the same $100, you would have got only 1/6 of X. So the fundamental issue is that there is not much output coming out because the amount of materials is limited inside Earth. Okay, so that's the first thing. Second thing is in this past 7 years, because of ESG guidelines, environmental social guidelines, the capital investment towards taking these minerals out has reduced by these minerals exploration companies. So they are far more interested in paying dividends than actually doing capex. So because of that, also the supply has reduced. Because of this fundamental lack of supply of commodities, these commodities are going to be in a secular uptrend for almost next 5 years, 10 years kind of scenario. And if this is the trend, then inflation is going to remain elevated for some time. And that has been accentuated more by the fiscal spending by the developed market governments like US, UK. Fortunately, unfortunately, in India, we didn't have much amount of fiscal spending. RBI did the heavy lifting, and that's how we have come out of the COVID era. But if you look at globally also, I mean, the amount of inflation in US is right now 8%, 8.5% odd, which was the number for the last month. And that compares to 6.95% in India. So can you imagine an CPI number in a developed market at 8.5%? That's extremely, extremely unimaginable. Okay. So the point I'm trying to make here is that over the period of next 9 months to 12 months, US Fed is likely to go for a series of hikes. I mean, there are 6 meetings left. You would have at least 175 to 200 bips kind of hike in a matter of 9 months. So what does it imply? It implies that with such amount of rate hikes in US, obviously dollar as an currency is going to find more bids, and then you would see more FPI outflows from emerging market or risk assets. So my sense is that the FPI selling is yet to subside from the current levels. 2022 is going to be a very difficult year for risk assets. I'm not just talking about equities. I'm talking about all kinds of risk assets. So when I say risk asset, I imply emerging market assets, whether it is EMFX, whether it is EM debt, EM equities, anything, right? So from that point of view, you as an investor, you need to keep on reading about what's happening globally, what's happening locally in terms of macroeconomic. And once you read about these things, you would understand that at some point of time, you need to take some amount of risk off your investment book. And what is the best way to do it? You need to put some amount of investments into debt. You need to book some profits of equities. You need to shift your capital to some amount of debt. And that should give you some decent amount of conservation or some decent amount of risk buffering against whenever there is a meltdown in risk assets.
Yeah, so let's develop on this thought. So you have touched upon on the inflation and the interest rate hike. So as we all understand and we read the newspaper, is like there is going to be a tapering in the US and the interest rate will rise, and that will lead to the outflow of capital from the emerging market, and that will have impact on the forex market. So that's one type of volatility that will come in forex market. Second is because the interest rate hike is happening in US, the other emerging markets, to keep them attractive, will also follow the suit. So, and at the same point, the inflation is eating into the savings. So, what I understand, Satyakam, and when the interest rate increases, say the GSEC, the yield curve moves upward. So, the price of bond goes down. So, isn't it negative for a retail individual? Like if he invests it and the price of bond going out. So, in this case, rather than capital preservation, it's a capital loss happening for them. So, what should one investor do?
Right. So as I said in the beginning, the right way to look or invest into debt in a rising interest rate scenario is, first of all, you need to have a clarity on your cash flow. So if your cash flow is, let's say, 6 years clear to you, then you need to invest into a straightaway 6-year SDL, which gives you a decent return. Okay. 5-year SDL is giving 7.10, 7.05% return. So that return is locked in. Okay. So that is your, what you call is IRR for the next 6 years. Okay. So, and that is beating your current FD rate of whatever 5.45%. Okay. So if you are clear about your cash requirement, that you're not going to touch that or you don't need that in the next 5 years, that's the best way to go about it. That's the first answer. The second answer is, I mean, purely from a micro point of view, earlier I have covered the macro point. Now I'm covering the micro point. The what you call it, the credit spreads do not compress that much in times of rising interest rate scenario, and especially in India, because what has happened in the last 2 years, the yield curves for the AAA names have really compressed. I mean, they were sometimes going below GSEC yields also. Okay, but now, and for the last 2 years, the AA names and below and the sub AA name credits yields have still remained at 12%, 14%, and that is a delta of around how much? Let's say 600 bips or 500 bips, right? Now, if 500 bips carry protection is sufficient to take care of whatever MTM is going to come, especially if it is a short end paper. So if it is a paper of 1.5 years and you're getting at 14%, you're getting a carry protection of 500 bips. How much wrong can you go, right? So 14%, let's say 14% paper gets traded at 16%. Okay. So what's your carry? Your carry is 14%. The moderation of that paper is 1 year. You remove 200 points out of that 14%, you still make 12%, right?
Yeah, and
So,
I think the retail individuals don't even have an option to sell it in the market because the liquidity is less. So it's more of a theoretical risk when we talk about retail individuals, the MTM one. So,
yes,
so, so as you rightly mentioned, is one should put money in these opportunities till the maturity. And if
yes,
they have ample cash, so they would be protected from the series of rate hikes. And since these are small tenor opportunities, so 1 to 2 years, it will not impact them much. Had it been a 10-year opportunity, it would have impacted them more. Is that a
yes.
right understanding, Satyakam?
That's a right understanding. And as a retail investor, what I would suggest is that you should not be looking at debt from a trading point of view. Okay.
Okay.
Okay. So as a retail, you can look at equity from a trading point of view. But when you're looking at debt from a retail point of view, it should be with respect to investment point of view. So if I have a visibility on my cash flow for the next 1 year, 2 year, for my 20% of my overall cash pool, of my overall investment pool. Okay. So then I should go and do invest in these AA names where obviously I've done my enough research. Obviously, I've talked to the, let's say, most of the advisors, and then made a conscious and informative call about it.
Yeah. So I'll just move on to the audience question. So I'll urge all our audiences and attendees to post a question in the Q&A section, and I'll take them one by one. So there is a question from Mr. Ganesh Mani. So any number of US dollar on the outflow that could happen. Anything, any sense you have 10 billion, 15 or 20 billion that he's asking?
So my sense is that right now we are in the month of April. Okay. So assuming that there is around 175 to 200 bips of rate hikes by Fed in this remaining part of the calendar year. So you would see minimum again 20 to 25 billion dollars outflow in FY23 from equities.
20 to 25 billion, that's a lot.
Yeah.
Okay. So another question is from Mr. Sanjay Chandel. So he wants to thank you for the insights that you gave on the commodity price movement due to actual dip in mining activity. And these were very helpful for him. And he wants you to suggest some regular readings that he should do to keep himself updated on such issues.
Right. So my sense is that try to get logins. You need to invest into your reading. Okay. So you have to invest into your knowledge building also. So try to get, let's say, subscription of Business Standard, Economic Times, or Live Mint, or WSJ, Wall Street Journal, or FT, because these articles are really genuine articles. They are informative articles, and once you go through them, you would get a multiple opinion point of view. Okay. So the more you read, the more opinions you come across, and then the better opinion you can also form. Okay. So reading is the only way. That's the first way. The second way is talking to participants who are part of that market. So if you have got somebody who is working in commodities, export, commodities trade, if you can talk to them, people who are working in shipping lines, they would also give you a good idea about what's happening in commodities. So human communication is also a way of building that knowledge pool.
Great. So another question is from Mr. Prasanna Bhagwan. He wants to know how big is the debt market in India? Is there any specific number? And he wants you to further speculate and how big that market will be in next 10 to 15 years.
Look, outstanding GSEC, I think, is 60 lakh crores outstanding GSEC. Okay. GSEC government, that means Government Securities of India. I have not a number on the outstanding corporate bond, but my sense is that as we go ahead, these numbers are going to increase, but these numbers are going to increase purely from an institutional demand point of view. If you really want to have retail into debt investments, you need to have more products like Zerodha. Okay, Zerodha has revolutionized the entire equity investment. We need to have your kind of platforms where it's easier to buy and easier to sell. Okay, where products are easily tradable, where the bids and offers of any bond, whether it is a high yield trade bond also, are very narrow. So once you are able to give those kind of comfort and the ease of execution, same day return of funds, then perhaps you would see more retail participation and more what you call is increase in the overall market also.
Yeah, so Satyakam, we'll take this feedback, and I now understand that you have not invested through our platform. So then you would have mentioned our name also, that the ease of investment, that's something we also pride on, and it takes only 2 minutes to do the KYC and invest through us. And a follow-up question to the same, it is for me, I'll address this. So Mr. Shashindran Nair. So when can we expect a state-of-the-art mobile application of Giraffe? So Mr. Nair, we are already working on it. So it is sometime away. We will let you know as soon as it launches. So you can register on our website. The moment we come with it, we'll be sending an update to it, and then you can do it. So the plan is in progress. We are taking baby steps, but we will surely get there. Another one is from Madhur. The question is capital investment security. Like how much is it? It is secure.
In bond investments?
I hope so. I also didn't get the full question. So I think when you're saying it is secure, the bond market, what percentage of it is secured? I think that's the question is being asked.
So once I don't have a number on that of the overall market, but if you are investing in bonds, especially high yield bonds, just ensure that those are secured. Okay, just ensure that ideally I would not recommend very unknown names. Okay, so those names should be fairly liquid, should be fairly common. The performance and should be pretty consistent for the last 5 years. So that's my sense.
Okay. There's some more questions that have come up. Let me scroll down. So another question is from Srinivasa Gopalan. So for next 5 to 8 years, debt yield will defeat every return. If yes, what kind of debt instruments are better for a retail investor?
That's an excellent question. I mean, you have to understand in a rising interest rate scenario, FD rates move with a lag, whereas the debt capital market yields actually have already moved. Okay, so if you look at the FD rates, they have hardly budged in the last 6 months or so by 10-15 bips max. But if you look at the corporate bond curve, they have already shifted by 150 to 200 bips post the pivot by the MPC in the last meeting on 8th of April. So my sense is that the rates which are being offered by FD, they do not compensate for the carry which you are getting in, for that matter, AAA corporate bonds also. And especially in credit, let's say high yield credit bonds, the yields you are getting at 12%, 14% in 1 year. I think they are significant accrual and one should go for it.
Okay. And another is from Nikhil. What are the key economic data points that you regularly track?
So for India, you need to track CPI, IIP, core production, GDP, monthly retail sales, current account data, trade deficit. These are the numbers which are, let's say, released by the government agencies in India. There are other major fact sheets prepared by many mutual funds, insurance companies, etc., corporate houses, which are in public domain, which you can also go through. For global markets, you just need to keep an eye on US and China for that matter, in Europe. What are their interest rates currently? How are they likely to move in the next 6 months or 1 year? Non-farm payrolls, which is the employment data in US, retail sales, PMIs globally. So these are some of the data points which you need to keep an eye for understanding what's likely to evolve in macroeconomics.
And there's another question from Ms. Shinu. How much percentage should anybody dedicate to alternate investment? Is there any thumb rule, any formula like you have in age about 100 minus whatever your age into debt and equity? Any short hack, something of that sort you would like to give?
That's Vikas. That formula you need to develop for your app also. That in that app you can put in that formula that if you put in the age, you can calculate how much percentage needs to be allocated to the alternative investments.
Yeah. So since Satyakam has diverted this question to me, so I think historically these are the new asset class. So one should start investing it in steady and slowly, build up their portfolio. They should try to understand the product. There is no hurry. So one should first understand the opportunity, understand the risk, and take baby steps. And once you have got the taste of it, how the product works, then should increase your portfolio. So since there is no formula to it, it definitely, as I gave you on the third slide, it's the risk profile is between equity and FDs. So one should look if they are a more conservative or aggressive investor, and then accordingly to their risk appetite, they should look at investing. So the idea of investment is that you should be able to sleep sound at night. It should not make you worry. So that is the thumb rule, which I follow.
Very
So,
much true.
Another comments, I think most of them are Giraffe specific questions. So one of the advice that we will take is like you have a very high benchmark. This is 50,000 minimum ticket size. Sorry, it is 1 lakh. It should be reduced to 50,000. And there is a question from Arunachal Muthu. What is the difference? This is again to you, Satyakam. Senior secured, unsecured, covered bond. What is this jargon he wants to understand in regards to the bonds?
So all the bonds which are being issued, they are either secured or unsecured. There is a security cover ratio in terms of all these bonds. So you need to go in the IM, the information memorandum of the bond, and figure out what is the security cover for that individual bond. If it is anything between 1.25 to 1.5, I think it is decent.
Fair enough.
Unsecured bonds are more risky. They carry higher yields and they are definitely riskier than secured bonds. And I would not advise for a retail to start from unsecured bonds. That is something far for higher vintage clients.
Okay, just to add, Mr. Muthu, covered bond is something which has been discontinued as per RBI regulations. So you need not worry about covered bonds. Between senior secured and unsecured, it's fairly simple. Secured is any bond which is backed by an asset or a security. Unsecured is instrument which is not backed by any security. So there is no collateral to the bond being issued. That's the difference. And I think there is a question from Mr. Venkateshwara Rao regarding the security for invoice discounting. So Mr. Venkateshwara, we will reply to you offline because this question is not pertinent to the discussion at hand. So we'll get back to you and explain you the entire nuances, what are the securities or invoice discounting, because it depends on the case-to-case basis. And I'll just another generic question that Gaurav has asked, like how do I refer my friends, that will take offline. And Lohit has asked a very interesting question from me. Can I be a borrower in Giraffe? Yes, sir. You can be a borrower in Giraffe. You can contact our support, and we will obviously do the due diligence. And if you pass our benchmarks, we'll be surely be happy to list your opportunity. I think we have answered all the questions that have been listed here. And thanks a lot, Satyakam, for joining us in the evening on the long weekend. And I'll similarly like to thank all our audiences who have joined us on holiday. And we hope to see you again. And we will continue this web connect with Satyakam for 3-4 more sessions at least. And if you have any further queries for Satyakam or me, please write to us on our support@giraffe.com, and we'll try to address it. And if there's any topic you would like to have us covered, please let us know. We'll be happy to address it. Thanks a lot and good evening to everyone. Have a good weekend.
Thank you, Vikas, and thank you everyone for who has connected. Thank you so much. Have a good weekend.
Thank you. Thanks, guys.